Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dick's Sporting Goods Inc. Annual Report. Dick's Sporting Goods Inc. offers a wide range of products and services through its various business segments. The company provides hardlines such as sporting goods equipment, fitness equipment, golf equipment, and fishing gear products, as well as apparel. In addition to these core offerings, Dick's also sells footwear and accessories for various sports and activities. The company operates several specialty concept stores under different banners, including Sporting Goods, Golf Galaxy, Public Lands, Moosejaw, and Going Gone. These stores offer a unique shopping experience for customers looking for specific products or services. Furthermore, Dick's owns and operates Foot Locker, which includes multiple banners such as Foot Locker, Kids Foot Locker, Champs Sports, WSS, and Atmos. In addition to its brick-and-mortar locations, Dick's also offers online shopping through its website and mobile apps. The company's e-commerce platform allows customers to browse and purchase products from the comfort of their own homes. Moreover, Dick's provides a youth sports mobile app called Game Changer, which enables live streaming, scheduling, communications, and scorekeeping for young athletes. Overall, Dick's Sporting Goods, Inc. is a comprehensive retailer that offers a vast array of products and services to meet the needs of customers across various demographics and interests. Dick's Sporting Goods, Inc. maintains a market capitalization of $18 billion, broadly in line with the industry peer group. Dick's Sporting Goods, Inc. trades at a higher price-to-earnings ratio of 20 times and a higher price-to-book ratio of 3.17 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 68% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.53%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth in the company's business are multifaceted. One key factor is the comparable sales growth in Dick's business, which has been steadily increasing by 2% to 4%. Additionally, the strategic expansion of square footage and strong profitability for Dick's business have contributed significantly to revenue growth. The acquisition of Foot Locker has also played a crucial role, with $3.1 billion in net sales added to the company's revenue in fiscal 2025. Furthermore, the increasing demand for sports products, due to consumers prioritizing sport and maintaining healthy lifestyles, has driven revenue growth. The convergence of sport and culture has also created new opportunities for the company to grow its business. Investments in key categories have supported sales growth, with $374.5 million invested in these areas. Finally, lower income tax payments following the enactment of provisions in the OBBBA and higher cash flows received from landlords due to store repositioning and investment in store portfolio have also contributed to revenue growth. On the other hand, the primary drivers of revenue decline are largely related to decreased profitability. The decrease in gross profit as a percentage of net sales by 298 basis points has had a significant impact on revenue. Additionally, lower gross margin in the Foot Locker business and increased selling, general and administrative expenses have also contributed to revenue decline. Inventory reserves, allowance for credit losses, and reserve for sales returns have also negatively impacted revenue. The net income of a company underwent significant changes over 2 fiscal years. Initially, it decreased by 28.3% from $1.17 billion to $849.2 million. This decline continued with a further decrease of 33.8% from fiscal 2024 to fiscal 2025. Additionally, the net income dropped by 24.6% in 2025 compared to 2024. The profit margins also experienced a substantial decline. The company's profit margin decreased by minus 374 basis points, dropping from 8.67% to 4.93%. Furthermore, it declined by minus 298 basis points, reducing from 35.9% to 32.92%. A more modest decrease of approximately 2.6% was observed from 2024 to 2025. The reasons behind these changes are multifaceted. Acquisition-related costs and asset impairment charges significantly contributed to the decline in net income and profit margins. The write-down and liquidation of Foot Locker inventory, valued at $217.9 million, also had a negative impact on gross margin in the Foot Locker business. Increased selling, general, and administrative expenses due to strategic investments in technology, talent, and marketing further exacerbated the situation. Finally, an increase in the effective tax rate from 23.3% in 2024 to 25.6% in the current year also played a role in the decline of net income and profit margins. The company's financial performance is a testament to its ability to generate significant operating cash flows. According to the provided data, the net cash provided by operating activities has been consistently high over the past 3 years. In 2026, the company generated $1,537,343,000 in operating cash flow, followed by $1,311,835,000 in 2025 and $1,527,335,000 in 2024. These figures demonstrate a strong ability to produce positive operating cash flows, indicating that the company is financially stable and capable of meeting its obligations. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the total debt increased by $2.5 billion due to the acquisition of Foot Locker. However, this was followed by a decrease in long-term debt and financing lease obligations of minus $420,760. This indicates that despite an initial surge in debt, the company has managed to reduce its long-term liabilities. In terms of interest expenses, there is conflicting information provided in the summaries. However, based on the most recent data, it appears that interest expense has increased by 21% from 2024 to 2025. This contradicts earlier reports suggesting a decrease in interest expenses. Despite this increase, the company's overall financial health remains stable, with no significant changes in its debt level or interest expenses that would raise major concerns. The company's performance varied across different segments and regions. On the positive side, Dick's business saw success in its new store concepts and formats, particularly in larger format specialty stores. The e-commerce segment also performed well, contributing to the company's overall growth. Additionally, Foot Locker's introduction of the Fast Break initiative improved product assortment, while maintaining and acquiring locations in urban retail corridors proved beneficial. In contrast, professional sports teams within core regions of operations struggled, negatively impacting surrounding areas with high customer concentration and demand. These underperforming teams had a ripple effect on the company's performance in these regions, resulting in poor results. The management is optimistic about the company's outlook, citing a 28.1% increase in net sales in fiscal 2025 as evidence of its success. To sustain this growth, the company is investing heavily in new stores and digital initiatives, including emerging growth opportunities such as the Game Changer platform and Dick's Media Network. The company is also prioritizing quality assortment to improve gross profit margins, while repositioning its store portfolio through conversions and relocations. This includes closing unproductive assets, such as 7 WSS stores, and expanding its Dick's Fieldhouse concept with new locations. Financially, the company expects total net sales of $22.1 billion to $22.4 billion in 2026, with comparable sales growth for the Dick's business of 2% to 4%. The target segment profit for the Dick's business is $1.58 billion to $1.66 billion, or 11% to 11.2% as a percentage of net sales. The acquisition of Foot Locker in September 2025 is also expected to contribute significantly to the company's growth and profitability. Additionally, the company has authorized an additional 5-year share repurchase program of up to $3 billion and increased its quarterly dividend by 3% to $1.25 per share. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the most notable one is the purchase of Foot Locker for $2.5 billion. This acquisition was a significant move to expand the company's presence in the market. In addition to the Foot Locker acquisition, the company also recognized goodwill related to the excessive acquisition cost over the fair value of the net assets of acquired entities. This indicates that the company paid more than the actual worth of the acquired entities, which is a common practice in business acquisitions. On the other hand, the company has also made several divestitures as part of its strategy to streamline operations and focus on core businesses. These include the closure of underperforming stores within the Foot Locker segment, the closure of a European distribution center in Hygen, Netherlands, and the elimination of certain positions at CSC. Furthermore, the company has also closed 10 Musajau stores as part of its efforts to optimize its retail operations. These divestitures are aimed at improving the company's overall performance and competitiveness in the market. The company has a history of rewarding its shareholders through various means. One way it does this is by paying dividends on a quarterly basis. This practice not only benefits existing shareholders, but also attracts new ones who are looking for stable returns on their investments. In addition to paying dividends, the company has also been actively buying back shares from the market. This strategy allows the company to reduce its outstanding share count and increase earnings per share, thereby benefiting its remaining shareholders. The company's commitment to share buybacks is evident in its increasing investment in this area over time. That concludes the financial summary for DICK'S Sporting Goods Inc. Feel free to comment below, and I will be happy to answer them when possible.